Move into our panel discussion looking at the 25 years of privatisation of the water sector. And a welcome to our panellists, Ian Byatt, who I think can fairly be called the founding father of Ofwat, Lord Moynihan, who steered the bill for water privatisation through the House of Commons, Colin, Skellett, who's been running Wessex Water for the full 25 years of privatisation, and Jonson, who, having run a couple of water companies, is now chairman of Ofwat. So to get our discussion started, gentlemen, I'm going to ask you just to give me some brief thoughts on how you would state the objectives of water privatisation and to what extent you believe they've been achieved. Ian, can I start with you?
Okay. I calculate that I've been involved in the water industry for about 45 years, professionally that is. I was washed earlier, and maybe it's time for me to retire, but it is quite nice to come back to what is a really exciting and interesting and developing industry. And one of the things that is clearly sustainable is that the radical and unique in the world privatisation of water services is sustainable. The taps work well, subject to some adjustment perhaps of the washers. Huge credit to Nick Ridley, his fellow ministers and advisers, for separating public objectives from public provision and establishing both economic and quality regulation. And privatisation has exposed, or perhaps I should say has started to expose, the industry to market forces and economic incentives, both in capital and labour markets, facilitating the development of domestic metering and increasing customer choice. It gave the industry access to capital markets and promoted a doubling of investment. National pay policy, I'm glad to say, went into the waste paper basket. What has not proved sustainable is significant and continuous increases in price in excess of inflation. Tariffs should go down as well as up, requiring a balancing of greater efficiency in supply and the volume of investment in water and wastewater quality. And I was delighted to hear the Minister talking about costs going down. For so many years, of course, not ministers, but Defra officials have talked about the inevitable increase in costs. Now we change. Good. We need to avoid a capital bias. Investment is fine, but it needs to be properly analysed. And the use of more environmentally sensible methods can cut the need for concrete. And this is very clear in the case of the Thames super sewer, where better environmental results can be produced at massively lower costs. Sustainability also requires tightening the ring fencing of the utility, both with respect to dividends, which has become a big problem, and governance, which really needs addressing. And sustainability does not involve putting more obligations on regulators. Rather, we should seek to fulfill the privatisation promise of benefits to customers. And finally, as Bill Clinton might have said, KISS, keep it simple, stupid.
Thank you.
Just going back to the genesis of privatisation, it's interesting to reflect that it was a deeply unpopular measure at the time, the most unpopular of all the privatisations, and I think in many respects the most successful. The backcloth of the preparation of that legislation was real concern about French acquisitions of 3 of the statutory water companies at the time, and ownership was a really important political issue and created a lot of opposition. We've moved now in 25 years from focus on ownership to focus on brand management, but we'd never have anticipated that at the time. Secondly, we had a real problem with the European Commission in terms of achieving the water compliance targets, in terms of the environmental standards that were being set by Brussels. These were being ratcheted up faster than we were preparing the legislation. And realistically, as a ministerial team, there was real concern about whether we were ever going to be able to deal with that. And a driving force behind the legislation was to address that challenge, that objective. Thirdly, it was clear that politicians were not going to place putting public funding at a sufficiently high priority when it comes to decisions at Treasury level into the water sector. And we needed, and this was the most important rationale for the whole privatisation proposal, to allow the industry to access the capital markets to meet the investment requirements that were necessary to upgrade and to compete, to meet the water standards that I've mentioned, and to be competitive in the future. I spent 110 hours piloting the legislation through as very much the junior minister on the team, fortunately aided by Michael Howard as an astute lawyer and by Nick Ridley, who was passionately supportive of this measure. We had a number of challenges. One was there was little belief in the country and less belief in the committee of the bill that Ofwat could ever achieve this concept of comparative competition, which was new and which very few people believed could be delivered. And I remember having to argue this probably for 30 or 40 hours. And I began to be persuaded that this was a tough task. The reason why a lot of this succeeded is because of the quality of the people who were in those companies, and in particularly I pay credit to Ian for doing an extraordinary job in ensuring that Ofwat really tackled some of these what seemed at the time to be insuperable challenges. One was the relationship between the split between the National Rivers Authority, as it was at that point, and Ofwat. And Nick Edwards at the time was put in charge of the NRA, and Ian, the decision was made, would look after Ofwat. And quite frequently there were cartoons in the papers of the two of them in a boxing ring. I mean, such was the public perception of the relationship between the two. Two of those cartoons hang in one of the downstairs toilets of Nick Howell to this day. But they had a very constructive relationship in dealing with a very tough issue. The next point was that the companies were full of, if I might say so, pretty strong egos. There were some big characters at the time, and they were arguing issues such as whether or not we should float them all on the same day, whether they should be floated in groups. And of course, they were competing against each other to maximize the uplift in their share prices. So preparation for that was an interesting dynamic, because it was a field day for bankers, for consultants, and for tough negotiations with officials. The final point I'd make in answer to the question about what it was like 25 years ago is that metering was very much part of the bill, and we set off, believe it or not, to have a series of trials around the country, compulsory metering trials. And I had to visit the first two to address public meetings, and in both of those I needed police protection, one in Normanton and one in the Isle of Wight. And such was the opposition to being party to a trial for compulsory metering that it was a reflection of the time of how difficult and unpopular this measure was. The success of it, in a nutshell, was compliance was significantly improved. We nearly reached 100% compliance on both the water standards, the environmental standards. The companies accessed the capital markets. There is no question that customer bills were controlled. We had a very strong and effective regulator who saw things in the round and worked constructively and highly professionally with the companies. And the dynamic, which to this day is still relevant, between the department, Ofwat, and the companies, and it's a critically important dynamic for this model to work, did work. And as I said at the beginning, it's to Ian's credit that that was achieved. We've travelled a long way, and I'm sure in the next couple of questions we'll talk about where we are today and where we're going in the future. But I think it is important to set in context that this was a very tough ask of government. It was deeply, deeply unpopular all the way through its passage in both houses. And I'm glad to report that it succeeded.
Thank you.
I think it's worth reflecting, just adding to the reasons for privatisation. Colin's absolutely right. The main reason was that the public sector couldn't fund all of these improvements. For almost 15 years, regional water authorities had existed, and their constant problem was not enough money. They weren't allowed to borrow enough. And it got to the stage where several of the companies started to object in public. And also, the Treasury were using the water companies effectively for tax collectors because money was being siphoned off and borrowing wasn't allowed. So you had a combination of the water companies wanting something different, government concerned about infraction proceedings, and something had to give. And it's worked. We had 110 billion of private sector money that's been invested to deliver all the things that Dan talked about. So yes, it worked. Did everything work? Probably not. Some things could have been done better, and no doubt we'll go on and talk about that. But fundamentally, it transformed this industry from an industry that was constantly underfunded to one that can access capital to do all the things that the industry needed to do. And actually, 25 years on, we're probably at a good place to think about the future because a lot of stuff has now been done, a lot of money's been raised. The original thinking was that there'd be about 10 years of high levels of investment to meet all the European standards, and then these companies would start to throw off cash and everything would stabilise down. Well, that bit hasn't quite worked. I also remember at the time there was a theory that ministers would never again have to go on the Today programme to talk about water or water industry issues because it would all be done by the independent regulator and it would be taken out of politics. Well, maybe that hasn't quite happened. But broadly, it has been a great success, and it's all credit to the people who devised the RAB-based model because it is unique and it is a really powerful model for allowing investors to invest with certainty and driving up efficiency, driving up improvements, and it's something we need to be really careful that we don't lose when we look at where we might go.
Thank you. Jonson?
Thank you. Ellen's caught me on tape saying something about it was, while a success, it was not a smooth but quite a bumpy journey. And I thought I'd just look at it for a moment through the eyes, as I perceive it, of customers over 25 years. And as Lord Moynihan said, customers didn't welcome this to start with, really quite a hostility to something that is a public right being privatised. And it's odd to think back, isn't it? I moved to Yorkshire in the early 90s, and I recall crossing the River Calder every day, and the trees on either side of that bank strewn with rags discharged from Huddersfield's wastewater treatment works. Absolutely despicable and disgusting. And I remember the sign in the Leeds Hilton, little sign in the bathroom that effectively told you not to worry about the water being a rather unpleasant shade of yellow, because it was, of course, the way the water came out of the tap in Leeds, originating as it did in the Pennines. The early part, the first 5-6 years of privatisation, were about companies getting to grips. And, of course, what it stood out was the successes weren't seen. What was seen was management distractions, excesses, behaviours, raiding the utility to fund and subsidise other enterprises. And what seared in my mind coming into running a water company in the mid-90s was words like leakage, distrust, and reputation. And I think that was a continuing theme for me of customer perception lagging improvement that was coming through in companies but was not perceived. And of course, the late 90s saw words like Colin's referred to metering, the beaches and the cost of clean water in the southwest, disconnection, I remember very well in Bradford as being a very big issue. And of course, customers sort of got one up when it came to PR 99, which was the seminal review that adjusted a review perhaps in a different direction in PR 94, and the beginning of saying to companies, remember to take your customers really with you on this. In early 2000s, I think customers were bewildered as they saw some of the diversification. I wrote down here, chickens come home to roost. And customers saying, what is my local water company doing? Colin knows better than me the story of
Enron and Wessex. So, of course, my own company, Yorkshire, was nearly the target. Thankfully, they moved to Wessex.
Wanted a better company.
Well, we certainly won't fall out over that. Hudder and the creation of Welsh Water, and of course Anglian Water Group, diversified into 22 countries, losing more in the rest of the world than it made in the UK. But what was established by then was this was a service under private ownership, and I think that's when we began to sense the questioning of privatisation fallen away, but with bewilderment. But life doesn't stop, because the 2006 period on saw what I think of as the beginning of a breakdown of the relationship between customers and capital again, for different reasons. And that was a breakdown because regulation was now established. It was firm, but it had become sold as the gold standard. It wasn't going to change. And we saw the opportunity for moves to drive up leverage very sensibly, to over-leveraging of companies, and too much reliance on financial engineering. And we saw exceptional returns in the period from 2000, certainly the last 3 years, which raised the question of why is this not being shared a bit better with customers? And that brings me to today, in the last 18 months, where I think in the constant evolution of regulation, and regulation should evolve, and it should evolve progressively and predictably, but a redefining of that relationship now looking forwards between customers and capital. And it's about fair returns to capital, and it's about working out how to share the unexpected and that beyond management control between customers and capital. It's about re-establishing the principles of board leadership in a public service environment with this very precious commodity and service that we have and provide, and the need to maintain legitimacy. And the need, in my mind, to re-establish, which is something we're trying to do in the PR14, re-establish that for managements in the sector, we are putting rewards and incentives back for operating the business really well, really efficiently, and delivering real outcomes for customers, and trying to diminish the ability for those that don't excel in those areas to mask that with the benefit of financial engineering. So I think that's where I get to, and the most important issue for me is that we are immensely privileged in this country, that we can and we have acceptance of the public that water and wastewater services provided by the private sector. Maintaining that above all seems to me, it's not our written duty as Ofwat, but it's actually the duty I almost take most seriously. And the last point I just want to make is, let's forget the extraordinary capability and talent of the people who provide water and wastewater service. It's not seen. The way people doing that have had to adjust to new technology, to new efficiencies, and it's a remarkable service. And I, for one, feel immensely privileged every time I go out and visit and see people who are providing this service on the ground. It's not noticed, but it's something we're all very reliant on. Thank you.
Thank you. Several of the panellists have touched upon the fact that I think really one of the first questions water companies had to answer was what is a water company and what should it do? And with all that access to capital and perhaps some of those big egos running the businesses at the time, not you, Colin, of course, I think there was a wide range of options and businesses diversified to the globe, across the globe, into all kinds of things, from leisure businesses to other infrastructure businesses, in a way that probably had never been envisaged. And Ian, you were sat in the regulator's chair watching all this. I'd be interested in your reflections from that time and the different approaches companies took.
To diversification?
Yeah.
Well, yes, I think that there was a feeling that, having been, so to speak, essentially public servants, or they weren't civil servants, but they were public servants, that privatisation opened the opportunity to be real business people. And real business people went out into the world in the way in which traders used to go out into the world and make money. And that would have been great if it had happened. But they went out into the world and unfortunately, largely, not universally, lost money, and sometimes on quite a substantial scale. And I was very worried about it indeed. And hence the emphasis on trying to ring fence the utility so that any losses made outside the utility could not be visited on the utility. And every time we had an opportunity, we would tighten those conditions slightly. And you find it was usually the best time to tighten them was when you got a change and people wanted something out of you, and this was a deal. And it was very helpful when it came to the Enron situation that we did it, and I didn't know quite what Enron was like. Nobody knew quite what Enron was like at the time. But when things went wrong, Enron bonds turned to junk, and Wessex Water bonds retained their investment grade status. So that was one of what I regard as a really key thing. And there may be other ways in which that could be done. So the ring fencing was the response initially to the diversification. Because what it meant was that then you had utility companies that could be bought and sold in the markets. So you strengthened the power of the capital markets. Capital markets, like all markets, are imperfect in various ways. Also interestingly, the stock market became quite disillusioned with the idea of diversification. And you found that the companies that weren't diversifying were the ones that the stock market liked. And one of the important things in regulating private businesses is that you can find allies when you're the regulator, and they vary, and you look for them, and in certain cases the stock market is the ally, in certain cases not.
Colin, would you like to?
Okay, I'm just going to say, I think with hindsight, one of the biggest mistakes was not to somehow allow the balance sheets only to be used for the water activities. Because privatisation didn't actually raise any money for the Treasury. It raised enough money to pay off the debts that the water companies had. And then all the companies were floated either with a clean balance sheet, or in the case of Thames, had a bit of debt injected. South West Water had some cash injected. But essentially, they got clean balance sheets. So boards were faced with all of these advisors toddling along saying, you should be investing in this. That balance sheet's not being well used. And we had all sorts of stuff. Funeral homes, Welsh Water went into hotels. And looking back, if we could have found a way of saying, actually, those balance sheets should be used for the core business, a lot of the problems we have today wouldn't be there. And we're trying to wind back from something that's been created by allowing companies to do things that it's fairly clear a lot of companies weren't equipped to go and do.
That is absolutely right. But it is important to reflect that at the moment of privatisation, there was a sense in the investor community that the core business, which was being moved from the public sector to the private sector, had very little room for manoeuvre in terms of returns to the shareholders. So that the non-core business commercial activities were a real attraction to the investors. So at the moment of privatisation, at that point, there was a sense in the market that let's have a look at these companies and let's invest behind those who have got attractive propositions when it comes to the non-core business commercial activities. So it's important to set that in context. That then changed for the reasons that you've heard either side of me, and then ultimately the ring fencing became a very important factor. But at the moment of privatisation, that was a defining criterion between a heavily regulated sector, which some investors saw as a shift from the public to the private sector without much upside potential, and the non-core business commercial activities, which were seen as the real growth areas and the cash cows for those management teams. Ultimately, as was made clear, that didn't happen. But at the time, that was the perception in the market to which the companies and their boards responded.
Just to say, I think what Colin says is Colin Skellett, about the use of the balance sheet is very important. I don't think we would have had the powers to do that, and also it would have been I suspect, really very complicated. And here there may have been a trade-off between complication and what we could do and what we could achieve.
I mean, there are some incredible stories, probably better told over an evening, of some of the diversification stories and some of the ineptitude in it. But let's leave that aside, because it's remarkable that actually the sector has survived that and remains, as it is, a strong provider of water and wastewater service. I do think the fallacy that very few seem to me to ever get was you could never change the financial structure, performance, dynamics of the water and wastewater business unless you materially diversified into other asset-based businesses. Everything else was just fiddling at the margins. And I couldn't understand why people wanted operating contracts and things that gave a few percentage points of profit at an operating level and didn't change the dynamics. I think the whole thing of diversification slowed by about 10 years. The real focus there could have been on improving water and wastewater, but we shouldn't beat up too hard on it because the sector has survived and come through. Painful lessons have been learnt, but we've got something to be proud of today.
Let's think a little bit about the role of the regulator. And Colin, I'd be interested, you in putting the bill through, were kind of designing the regulator, and that was supposed to be an independent economic regulator. When you look at the role of the regulator now in the current water bill going through, what reflections do you have on the change?
Well, here I'm completely aligned to Ian's concept earlier that regulation should be kept simple. There was a clear duty to promote competition in the regulator. That duty to promote competition meant looking after customer interests as well as promoting competition. And as a primary duty, I think that is absolutely the single most important duty that a regulator should have. Had it at the time, still has it today. The challenge is that every time a new bill is introduced into Parliament on water at the moment, there is an immediate focus on what additional duties can we give the regulator. So a big discussion and debate has just happened over resilience and whether or not it's resilience or increased efficiency and what we're going to call it. And then other amendments were tabled to this bill that is going through Parliament at the moment for yet further additional duties, both primary and secondary duties. There is a real danger that if every time we legislate on water, when we come to abstraction shortly, it'll happen again, new duties are introduced and legislated for. Politicians love them because it demonstrates that they are taking ownership of the challenges facing the industry. But ultimately, if you introduce too many duties and too much complexity for the regulator, you will end up with nationalisation via the back door. Now, I don't believe that will happen because I do believe that there is a dynamic that needs to be very seriously considered by governments of whatever complexion of getting the right investment levels, allowing the companies to be run as efficient businesses, to have the regulator undertaking its role, and government supporting that dynamic through legislation. But there is a real challenge of introducing a series of additional duties that add yet greater power and complexity to the role of the regulator, which denies the companies the right to get on and deliver the services and also attract the investment community in the future. And I've sensed that coming back after 25 years in the passage of the bill that is still before the House of Lords. And I also sense it in discussion that it's likely to continue to be the case over the next 10, 15 years, unless politicians really very seriously consider the consequences of their actions in this context.
Who'd like to come in on that? Ian, would you like to start?
I completely agree. I think it was a very brave government in the 80s and 90s that said, we'll set up regulators and we'll keep out. And there was an occasion, I think, when the energy minister, when asked about questions in the House about energy prices, said that is a matter for the Director General. I can't imagine that happening now, no, and more's the pity. The trouble is that you risk turning, well, more obligations risks turning the regulator into a politician, because you're giving him more conflicting high-level objectives. Now, I don't think regulators are trained to be politicians. They shouldn't be politicians. They're not elected. There's a real issue about the division of jobs and responsibilities. And the political matters should be kept to ministers. And that means not just handing them over to somebody else.
Jonson, you're in the hot seat. What's your view?
I thought Colin made a very good point about simplicity. The way I see it as a new to regulation, or new to this side of the table in regulation, is that over 90% of the value chain in water for the long foreseeable future will be a monopoly. And what do we know about the inherent tendencies of monopolies? The first is to take customers for granted, and the second is that managements in monopolies can be unchallenged and therefore, to put it politely, lose their edge. So why do we exist? We exist to make sure the interests of customers are really protected. Particularly in this sector, that efficient companies, and I'll keep labouring the word efficient, can raise finance, because we do need to go on raising finance, and that therefore there is a fair deal to customers. I see it as about as simple as that, with perhaps just an emphasis on the role we play, not only in protecting customers, but making sure companies keep feeling that tension to do ever better. And the fact that our system uses incentives to do that has been proven time and again to be a very powerful way. It's a lot better to work for an incentive than having a big stick. And underlying it all, for me as a now regulator, is this obligation to make sure that customers could not be harmed by the failure of the service, and that the service could not, by accident or default, fall back into the public sector because the sector had been neglected.
Colin.
The most important thing for this industry is regulation is seen to be strong and independent, because that's why people invest. And if we ever divert from that, it'll put up the cost of raising money. And I think Jonson's been doing a really good job of, in some ways, saving the industry from itself, because Ofwat is not perceived like Ofgem is being perceived. It is being perceived as a good regulator. Regulation needs to be simple, and it needs to be in the round. Ian used to do deals in the round. I fear that in between, we sort of drifted off into much more detailed regulation. And part of it is because the industry, some companies, made a mess of it. You know, if people put in information that's not correct, you expect a regulator to ask for a lot more detail. But the net effect is, if you're not careful, is the regulator then starts to collect lots and lots of information, starts to micromanage businesses that is not their business, or they've got the capabilities to micromanage. So regulation in the round, independent regulation, is really important for us. I mean, there are other forms of regulation around. 25% of the UK water companies have been in the private sector for over 100 years, probably over 150 years, and they were regulated with a cap on dividends. Net result, gross inefficiency, and an awful lot of waste. So, you know, we should defend the regulatory system we've got, and we should make sure it is simple and it is demonstrably independent.
Did you want to come back on that, Jonson?
No.
Okay. I think one of the other areas of really major change over the past 25 years is ownership. And in the process of putting together the report that you've got, I heard some great stories about the early days of ownership. Colin, I remember you telling me that the majority of Wessex's owners, its shareholders, were customers and employees. The world has changed a lot since then, and I'd be interested in the panel's reflections on how that changing ownership profile has changed the business of water. Colin, I'll start with you.
Wider share ownership was part of what was achieved with the flotation, and all the companies had big AGMs with lots of customers there, and there was a feeling that customers were properly engaged. Didn't last very long, because customers sell out for higher offers. So ownership very quickly shifted into the pension funds, but then more latterly into a mix of ownership. And I sort of come back to the fact that why do people buy water companies? I mean, fundamentally, water companies are worth their RAB value plus a little bit for outperformance. You know, that's what water companies are worth. But people were paying fancy multiples because they believed they could get something else out of it. We had the bizarre position when we were owned by Enron. They formed this thing called Zurichs. And at one stage, Zurichs shares were trading with a P of 45, and their only earnings were Wessex Water. And water companies at that stage had a P of about 8. You know, investors are peculiar people, and some people believe all sorts of magic can be achieved. And, you know, you can't. Fundamentally, these are safe, secure investments that should make a safe, secure return. But people have thought they could do more than that.
If you own a share, you get your return in two ways. You get a growth of the capital value, you hope, and you get a dividend. And it will be in the nature of an asset like a water company that it should have a fairly significant income yield and some modest capital growth. And the natural owner for that sort of stock is a pension fund, someone with a very long-term interest. We are indifferent whether that is private through institutional ownership or whether it's through the public listed markets. There are others apart from pension funds who may have such an interest, like customers of the service. But to my mind, it's a very simple model of what the ownership should look like, and it could come from almost sort of family, institutional, or listed markets, but somewhere at the back of it is very long-term pension fund ownership. What I think has got in the way has been when there's intermediaries between that ultimate owner of the capital and the company. And I have in mind some of the structurings that were led by banks at certain times. Colin's example is a good one of people who put a growth aspiration on an asset that did not have the ability to deliver that growth. So it's where there's intermediaries that it's sometimes gone wrong, I feel.
Any of the other panellists like to come in on that?
I agree. I once time said that the way to finance companies was by preference shares. Well, preference shares didn't really exist, but the concept was, I think, probably the right one. I worry about what is happening at the moment because it seems to me that the ownership structures of private equity are concerned primarily and perhaps exclusively, or I put this as a possibility, with getting money, with cash, with getting money out of the business. And that is not the right way to do things, because a long-run business won't work like that, and a business which has public responsibilities and won't work well like that. So I think it's a question of keeping close to the long-term owners, but also having governance structures which allow customers, among others, a proper say in what's going on.
I must come in on Ian's point, if I may, because I've been quite vocal about some of these structures, and it does. So we've seen this transfer of the sector from largely listed to largely unlisted. And we've got a variety of structures in there. If I take Colin's business, I don't think it's any more complex in its structure than it probably was as a public listed company, and has what I'd call a very vanilla financial structure, which seems to me very appropriate for the long term. Clearly some of the structures, and I've written and said some things that have been quite provocative about the complexity of these and the question of these may be very good, as Ian says, for deriving cash from the business. Do they really take customer legitimacy with? Do they maintain customers' integrity? And I was very heartened to hear a finance director of one of these companies say to me a little while ago, yeah, I get it. You know, being owned in the Cayman Islands does kind of not feel where a public utility should be. And I noticed we have an open door to prospective investors in the sector, and I very much welcome those who are now talking to us about a sort of vanilla straightforward, leveraged in accordance with roughly our guidelines sort of structures going forward. So I think we're seeing investor appetite start to change. Still strong appetite for the sector, but more akin with the very long run needs of the business.
I'm just going to say, Ellen, that it doesn't always work out for the investors. I mean, we've had two major American investors. We had one had a major stake, Waste Management. They went bust and everyone went to prison. Then with Enron, they went bust and they went to prison. So, it doesn't always work out.
From a political perspective, this is going to be a really important issue. I mentioned in my opening remarks that the ownership, I'm quite surprised how over the 25 years, the ownership question, as opposed to the brand, has not been as big a political issue as I would have anticipated it to be. But if that's as is, then the focus is on the brand and the brand management of a water company. And the ownership issue will come into focus again if the questions of high dividends, clever financial engineering do not lead to perceived gains of value to the customers. And if you look at some of Colin's recent presentations to the city and to the market, his whole thrust is, if you look 5 years, 10 years hence, this is about a service industry. This is about a customer service industry. And if the industry doesn't focus on customer service, then the politicians will reopen this whole question of ownership as opposed to brand management. And that, to me, is a really important challenge. And in the short run, it is an increasing discomfort with the clever financially engineered projects that benefit investors from America, Canada, Australia, and abroad, without commensurate service improvements or a sense of a return of value to the customers. And that is the short-term challenge that needs to be addressed.
I'm going to open now to questions from the floor. I see one at the back here.
It's more of a request for some additional information, really. We've talked about the changes over 25 years on improvements. Well, improvements are pointless unless you put it in a greater context. Where do you position the British water industry now compared with the rest of the world, our competitors or our partners, who've also improved and changed over the last 25 years? Have we incrementally improved against them, or are we just also runs?
Who wants to go?
Well, I'm not in a position to really give you a number to answer that as how much we've improved. We know the significant improvements here. Our benchmarking and the constant stream of international companies wanting to know how we've achieved this change in the UK suggests we're doing something pretty good. But that doesn't mean others aren't also doing things that are very good. I think that's all I can say.
Well, I think certainly on compliance and on standards, we are very much in the top league. It's much more difficult to do comparisons on price, because this is one of the few countries in which the customer funds everything. There's no, well, apart from in South West Water, where there's the 50 quid or whatever it is, everywhere else, everything, there are government interventions, there's a different way of funding. So it's quite difficult to make those comparisons. But in my view, at the time of privatisation, Colin says it was really unpopular. And there was lots of stuff around about how, it wasn't safe to drink the water, etc. We've got through all of that. And I think most people looking at the UK water industry would say it is miles better than it was, and it's amongst the best in the world.
Any more comments from the panel on that question? That's fine. I think we have another question here.
Good afternoon. My name's Phil Stride. I'm from Thames Water, and I'm head of the Thames Tideway Tunnel Project. And I'd just like to pick up on something that was said earlier. I think the first thing to say is that Thames Water totally supports sustainable drainage systems, but as you know, Thames Water do not believe that SUDS can deal with, in any viable way, the tens of millions of tonnes of combined sewer overflows that take place into the tidal River Thames every year. The problem is largely due to the fact that London's sewage system is still largely Victorian. So the issue to me is one of scale, which can be difficult to articulate sometimes. But just to imagine the size of these tunnels when they're complete. When the Thames Tideway Tunnel is complete and it connects to the Lee Tunnel, that will provide 1.6 million cubic metres of storage for combined sewer overflows. So just one final fact, the tunnels will be used 60 times a year and will full to absolute capacity, the 1.6 million cubic metres, 7 times a year. So my question is quite simple, Sir Ian. How would Suds deal with that volume of sewage? Thank you.
Quite a lot of work has been done on this tunnel and the alternatives to the tunnel, and the person I would refer most to is Chris Binney, who has produced some very recent work on the matter. I think it's quite clear that the analyses that led to the adoption of the tunnel were comparing, we're not allowing for the fact that there are a number of things you can do. So it was either Suds or the tunnel. It was either separation of foul and rainwater, or it was the tunnel. And I think by combining things, and this has been shown in a number of reports, that you could do things very much more cheaply, and I have now been persuaded you could do it in a very much more environmental way. In other words, strangely, I vote for the environment rather than concrete, and I believe that will save a lot of money, and that the whole scheme is based in the past and not in the way in which we can do things now. And there are certain examples from other countries, such as Philadelphia, that show this. But it's a big and complicated business and quite difficult to deal with in one question and one answer.
I think we could probably have a separate session on the Thames Tideway Tunnel, and perhaps we'll do that at some point. But moving on, have we got any other questions?
Colin McGlone again, Utility Week. This is just to the panel. Given retail non-domestic competition is due to come in 2017, I was just wondering whether you thought how, in the foreseeable future, there would be a chance of domestic competition.
Who wants to take that one?
I think we've got a job to do in making sure we deliver market opening effectively as an industry for business customers. And I know how strongly business customers want to see that choice. I don't think we have the same perception about household customers. So certainly as regulator, our focus at the moment is on effective market opening to business customers.
It was very generous of the Minister to refer to what has been a fairly lively couple of months of debate over getting the right framework in place for competition for the non-household sector. My own view is that we're there. We've still got to see exactly what the government is going to come forward with, but I liked the Minister's response that the principle now of exit, which was a critically important part of this debate, is now accepted. But what is very important is that as the Secretary of State comes forward with the appropriate framework for a competition, that we do take into account the consumer group's concerns, we do take into account the right framework to make sure that this is effective. I think with exit, and it was an interesting political debate, let me put it that way. I mean, it's been quite a tough one, but it's one in which the industry has moved during the passage of the bill. The regulator, Ofwat, was very clear in December in its evidence, and I think persuasive in that. The investor community have now demonstrated their support for it, not least Macquarie in their research note. The Defra Select Committee came out in favour of exit. I mean, not to have exit would have been an extraordinary decision for the working of what should be in place, which is an effective competitive market, for what is a very small percentage of the activities of the incumbent water companies. And I think that the first thing to do is to make sure that that sector works. I'm completely confident it will. I think it will have far-reaching consequences for the industry. And I think that what will happen amongst politicians, the regulator, and the industry is that we'll see how that works. And there are those who see it as quite a small step from the non-household sector to the household sector. I'm amongst those who would be of the view that we need to see how the non-household sector works. Let's learn lessons from that, but absolutely keep the door open to moving towards the household sector thereafter. And we must learn lessons from what's happened in Scotland. Scotland have been really impressive in this context. Business Stream are just around the corner here. If you just study their contract with Glasgow City Council and the savings that they have generated through that relationship, there are real opportunities here in the retail sector for competition to be effective and to benefit customers. So I would go step by step. Let's get the system right and the structure right. Let's make sure that thought goes into that. Let's make sure that the Ofwat are comfortable with the overall regulation of this. See how it works out. Let's not hold back from it. Let's move ahead. 2017 is when we should be triggering that activity. And then review, step back, review the strengths and the weaknesses from the competition in that sector. And I hope that that would then lead on to competition in the household sector.
It has, as Colin says, it has worked in Scotland. It has worked for public services as well as for businesses. I would go next, I think, to think about what trading you can engage in at the raw water and bulk water end. And then if, at the same time, domestic customers start worrying about not having competition, well, I think we'll begin to bring those in. But I think that the two ends of the chain are the places where you can really get the market to work. And what is competition but the market working?
Colin?
Well, I think we should, much as I love regulators, we should be working towards reducing regulators, and reduce regulators, reduce it by having more competition, because regulation is in there because there isn't competition. So the further we can go, and I agree we need to do it a step at a time, the further we can go to have competition. There's lots of places where you can have competition within the water industry. The less regulation, I think the better for everybody. And I think we owe Colin a particular debt for helping us change ministers' minds on exit, because it was absolute madness.
Question here.
Jerry Bryan, Albion Water. The Minister mentioned the work of the Water Sector Innovation Leadership Group, which I believe you chaired originally. Did you not?
Possibly.
And he also spoke of the importance of innovation. Now, listening to the debt market, they're saying that a 3.7 wholesale weighted average cost of capital is okay as long as the sector, or the wholesale sector, is further de-risked. How do you square further de-risking with a need for risky innovation?
So, Jerry, provocative question as always. So the committee or the little working group that I chaired for a couple of years was merely a governmental one, and governments aren't the people to do innovation, I don't think. I think necessity is the mother of innovation. Innovation, in my experience, comes about because you have a challenge that you can't meet through the conventional ways of meeting it. So I don't see this as linked to, in any way really, to the weighted average cost of capital that we set. There certainly could be a perverse outcome that if as the regulator we set a cost of capital that was not an efficient one, we might diminish the drive for innovation. And setting one at which an efficient company can survive and prosper is good, and would encourage the incentives inherent in that, would encourage companies to go further in innovation. So I believe what you might call a firm but fair determination by the regulator will prompt innovation. And innovation does not come, other than in any structural sense, from regulators or from governments. It comes from managements. And what I want to labour is why we are absolutely adamant in the incentives we set in PR14. They will be there to reward people who go further in reducing cost base, improving efficiency, or in delivering better outcomes. I think that's a huge stimulus to innovation, as indeed some of the structural changes that both Collins were talking about may also bring about.
There's no doubt we've got to innovate. I mean, the three big challenges for the industry are, on one side, we need to keep improving the existing infrastructure. You know, we keep forgetting this because the idea was you get through all these improvements in standards, then you start putting money into existing infrastructure. You know, we still invest on the basis that sewers are going to last for 800 years or water mains for 400 years. So we've got to do that, and a lot of that's going to be capital intensive. We've also got to deal with the consequences of climate change. You know, longer, drier periods, shorter, more intense rainfall. How do you square those with keeping bills down and keeping affordability? The only way has to be innovation. And I think where I'm not quite sure whether Jonson was saying the same thing or not, but the base cost of capital, fine for the base return, but there needs to be the incentives, the financial incentives as well on innovation, which I think is built into what you're proposing, Jonson.
Time, I think, for one more quick question. All questioned out? Okay, well, I'm just going to ask the panellists to close. We've spent an hour looking back over the past 25 years. So let's just spend a couple of minutes looking forward. As we come to the end of the session, I just ask each of the panellists to give me some brief views on what they see the major challenges are for the water industry in the coming 25 years. Jonson, can I start with you, please?
Well, fantastic sector and great record of achievement, but we need to avoid complacency. We need to use those market forces, the restructuring that we're talking about of the sector, and the incentives on companies to keep finding innovation and improvement, remembering that keeping the customer right in the centre is the most important thing, because if the customer ever loses their willingness to pay, everybody else is going to suffer.
I've already said what I think the big challenges are in terms of investment and affordability, but I think the biggest challenge of all is the legitimacy challenge, and that's about keeping customers informed, keeping customers engaged in a way that we have not done before. And that's why I keep banging on about social media and all this stuff, because it's a wonderful way of communicating directly with customers, and we need to do a lot more of that, because it's very, we come and have a seminar like this, the majority of customers aren't interested in all this stuff. What they're interested in is what do they pay and what do they get, and we need to keep building the service. We need keeping customers absolutely involved and told, and they're getting the sort of service they expect to get from a modern business, not a business that spends its time talking about how much it invests. And as you know, Ellen, if you stop calling it Utility Week, it'd be great, because we don't want to be utilities, we want to be service businesses.
Noted.
Me.
Colin.
Right, well, if we're going to be here in 5 to 10 years, the major discussion points are going to be over abstraction reform. There's going to be a huge debate over that over the next Parliament. And that comes back to the whole question of security of supply. It's a phrase that's often used in the oil and gas industry and the energy sector. It's going to become the term, in my view, in this sector. We're going to need to balance abstraction with demand. We're going to need to reflect on the increasing importance attached to fully functioning ecosystems. These are going to be really major issues that are going to need to be addressed. So the first one is the security of supply. The second is to make sure that, I've touched upon this, I won't labour it, the duties on the regulator are clear and simple and are driven by competition and customer protection. The third is the dawn of competition in the market that we've already talked about. There will be a big push for new services to businesses, for intelligent metering. I mean, I just came from taking 7 years out for the Olympics, and when I saw what happened with the Olympic Delivery Authority with the Aquatic Centre, and the whole design of the Aquatic Centre being geared to achieving 29% water reduction over its lifetime, and the opportunities to go to lab books and say, we can send you one bill on a computer printout rather than you getting 4 a year for each one of your outlets. You know, we're going to see a big change in the relationship between the business, between the water business and the business customers, and I think ultimately to the household sector as well. And then we're going to see, finally, I think, an increasing call by politicians for a national water resource strategy. I think that's going to come. It will involve issues like bulk transfer schemes. It will revisit approaches to river basin management. It will change the approach to the industry that we're used to today. So I think that national water resource strategy, I may not be a strong supporter of it myself, but I think that this is what's going to happen, and this is what we involved in different parts of the industry in this room are going to be facing.
Thank you. Ian?
I agree with my fellow panellists, and so I won't repeat any of those things. I just wanted to add 2 points. One is the whole question of what I call the costs of quality compliance. There's been a lot of going on, quite rightly, about customers being involved in the customer standards. What that means is whether you get someone to come round and fix something for you, can you rely on an appointment? It doesn't mean, do you think, that the costs of the European Wastewater Directive, etc., are worth paying. And I think there's a lot of work to be done in terms of costing these environmental obligations and then making sure they get in front of customers and are properly consulted on. And Anna Walker in her report made quite an issue of this. But this involves, of course, the political framework and not the regulatory framework, and it's quite a tricky one, but it's very important. And I can tell you the only time that Ofwat got itself into the daily sport was when we said water bills will go up by £65 and we got a girl in the shower. She wasn't in colour, but it got us on the map. The other thing is really trade-offs, and it's an extension of the same point, trade-offs between environmental and economic things. It's already come out in the Thames Tunnel context. But the Environment Agency, I'd like to get out of the world of Nick Crickhowell and Ian Byatt being in the boxing ring together to try and work out some ways in which they can sort things out. And I think that trade-offs and the examination of trade-offs and thinking about environmental trade-offs as well as economic trade-offs, not necessarily in cost-benefit terms, but in some kind of objective terms, that's an important thing that I hope will come about.
Thank you. As Jonson mentioned, he said in his interview for the Water Report, which you'll find on your chairs, that privatisation in the past 25 years has been a bumpy journey. Things went wrong, there were some unintended consequences, and there is work still to do, and I think we've discussed some of that work here today. But what is a reality is that there is a functioning and thriving market 25 years on that is delivering quality for customers. And I think that's thanks to the people on the ground, but also in no small part to the leadership of individuals such as these sat up here with me. So please join me in thanking our panellists. We'll be launching the report now, so please join us for a complimentary drink at the water bar. Thank you.